So to help us in this matter of better understanding what could happen in a flatlining stock market is fellow fiduciary here in the Louisville office, Mr. Wes Walker. Good morning, Wes.
Good morning, Tony. How are you?
I'm doing great, and thank you for being on. We got a little bit of a limited time. We're kind of running short, but this is a crucial topic because, as you know, I've been here, almost 6-7 years? Or
It'll be 6 years in January. Been here a little while.
And you've talked to hundreds of people. This whole question of how much, if any, should I invest in the stock market during retirement is a biggie. So what I wanted to do with you, because you're taking a lot of questions from current clients, is just go through a few of the common ones you receive, and you've kind of fed those to me and Derek. Derek's going to put them in the monitor. So let's get right to it. I like this one. What is the stock market, and why would anyone invest in the stock market in the first place?
Sure. So the stock market in general is just kind of this big amalgamation of different companies. You can think of it as all the companies in the United States or a foreign land or whatever that, index is tracking, all lumped together. That's, in theory, the stock market. Now, to expand beyond that, in the short term, stocks are like voting machines. People vote for their favorite companies. You see these companies run up in price. They have really great returns in the short term because people are voting for them. In the long term, though, the stock market is a weighing machine. It takes those companies that actually have had great results and promote them into higher highs rather than just public opinion as it does in the short term. So it's a very complex thing. It's very interconnected, but basically it's just companies in America and abroad.
That's a very good explanation. Okay, I like this one. Here's another question you pose, and you hear this a lot. When someone loses money in the stock market, where does that money go?
It's an interesting thing to think about. You would think that if you've lost money, that means maybe somebody else has made money or that you've somehow gotten the rug pulled out from under you. I would think about it like this. If you bought a home and all of a sudden there was some problem in housing and the value of your house could not sell for what it would prior, you didn't really lose any money. You did, of course, on paper, but it's just that the value of that asset is no longer as high as it used to be. So that same principle applies in the stock market. If you've got a basket of stocks and all of a sudden investors aren't willing to pay as much for them as they were prior, you've just had a paper loss and it's not worth as much as it was.
No, I like the homeowner analogy. That's a good one. Okay, so we got a couple of articles to cover. Now remember, our theme is, Wes, this whole idea that the market is always perfect, and it's not. We see it goes up and down. Then we've talked about this concept of flatlining. What's this recency bias all about? This comes to us from Charles Schwab.
Sure. So what finance has moved a lot toward lately is what's called behavioral finance. And it's not so much about the technical numbers behind everything. It's more about the psychology of money and investing. And this is one of these biases that a lot of people have expounded on. Recency bias just tells us that, you might become acclimated to a certain climate and think that that is going to continue forever, when in reality, it may not. So if times are good, people kind of get that feeling in the back of their head like, oh, this is just the normal. It'll always be like this. But that's kind of the scariest words in investing or personal finance is this time it's different. Things can always revert back to worse times, and in bad times, things can go back to being better. So recency bias is definitely something to look out for when investing.
I like that. And then you picked another one here, understanding sequence of returns and risk. And again, let's try to stay in our theme of somebody retiring. What's so important about this?
Well, sequence of returns risk is just a fancy way of saying catching a bad run. So like 2000 through 2002, you had negative market years, during that period. If you retired right prior to the year 2000 and you're watching your money go down year after year after year while you're taking withdrawals from it, that is just a recipe for disaster. And that's what really sequence of returns risk is. If you catch a good pocket in there, like let's say the 2013 bull run through 2016 or whatever, just a good few years, your numbers are going to look very, very rosy because the returns are high. You can take out distributions, you can increase your withdrawal rate, but if conditions are bad, that does present some sequence of returns risk just because markets aren't great.
And that's kind of happening right now, wouldn't you agree? Because we've got a pretty good run as we record this show in October 2025, but and that's only like a 3-year run. Was it 2022? We had a pretty good little hit to the market.
There was, but even that one was, it wasn't the biggest drawdown we've ever seen. So in recent memory, people forget about times like 2008, 2001. You can go all the way back to the 1929 Great Depression. These things can happen. And I think if you're not well suited for it in retirement, if you're not prepared with an income plan, a game plan, it's really hard to navigate those kind of waters. Derek brought up this chart. So this is actually the NASDAQ. So this isn't the S&P. This is more of a tech index. But if you looked and just said, hey, in the year 2000, if I popped all my money into the NASDAQ at once, it would be 15 years before you got back to even. And that's sequence of returns risk.
I got you.
So these kind of things can be mitigated by things like dollar cost averaging, annuity contracts, retirement income planning. That's what our focus is really making sure people can use their money in retirement.
Well, Wes, thank you so much for everything you do for our clients and answering all their questions.
Thanks for watching. We hope you enjoyed that video. If you'd like, check out these other clips. And be sure to hit that like button and that subscribe button for more videos.